In today's video, we're going to go over, can you contribute to Roth TSP and Roth IRA at the same time in the same year? Let's jump into it. Hey, this is Mel Stubbs. I'm a financial planner here at Christy Capital Management, and our goal is to bring you good, pertinent information for your retirement. So a question that we get a lot is, can I do Roth inside of the TSP and do Roth outside in an IRA in the same year? Well, the answer is that it depends. You know, if you look here, Roth IRA and Roth TSP are under different rules. IRAs are subject to IRS publication 590 and have contribution phase-outs, whereas the Roth TSP is subject to ERISA rules and it does not have income limits. So I'll start with Roth TSP. Right now, we are projecting for 2023 that you're going to be able to contribute $20,500 per year to the TSP if you are under the age of 50. If you're over the age of 50, we're projecting you're going to be able to contribute up to $28,000 to the TSP. Now, all of that money can go to the Roth side if you want it to. There's no income limit, so the highest paid federal employee can still do this. Now, keep in mind the match is going to go to traditional regardless of whether you select Roth or traditional for your contribution. So if you're maxing it out and you're over the age of 50, we're projecting you can contribute $28,000 to Roth TSP. Now, if you look over at the Roth IRA side, if you're under the age of 50, you can contribute $6,500. If you're over the age of 50, you can contribute $7,500. Now, there are phase-outs based on income levels. So if you're single or head of household and your modified adjusted gross income is somewhere between $138,000 a year and $153,000 a year, it starts to get phased out. And if your income is over $153,000, you cannot contribute directly to a Roth IRA. If you're married filing jointly, those phase-out numbers are $218,000 to $228,000 married filing jointly, modified adjusted gross income. So in this case, you can earn too much money and would not be allowed to contribute to a Roth IRA. However, at those income levels, you still could contribute to Roth TSP. They are subject to different rules. So the basis of the question is, can you do both? If your income is below the threshold and you're allowed to do Roth IRA, then yes, you can do Roth IRA and Roth TSP. Everybody can do Roth TSP regardless of your income. Roth IRA has that income phase out. So why would someone want to do both Roth TSP and Roth IRA? Well, here's some reasons why you should consider doing Roth in general. If you agree with these reasons, then you may want to be doing both of these. Number one, do you think taxes are going up? Here's the top marginal tax brackets for the last 109 years. And you'll see the highest level was 94% back in 1944. During the 1950s, it was 90% top marginal bracket. During the 70s, it was a 70% top bracket. Now you can see that this chart ends in 2015, but in 2022, the top bracket is 37%. That's much lower than historical norms have been. If you think tax brackets are going up, then you may want to consider doing Roth. Another question is, will the surviving spouse be in a higher tax bracket? Well, here's the 2022 tax brackets. So let's look at married filing jointly in the 22% bracket. It tops out at $178,150. If you or your spouse die the following tax year, you're going to be down at the single tax bracket. Now the 22% bracket tops out at $89,075. If one of the spouses dies, it almost acts like a tax increase. You move up the tax bracket much faster filing single than you do married filing jointly. And so it's kind of like a backdoor tax increase. This is a reason that you may want to consider doing more Roth while you're doing married filing jointly. The third thing that's good about Roth, well, at least Roth IRAs, is that there's no required minimum distributions. The IRS does not force you to start taking withdrawals from Roth IRA. Now, the reason I point out that Roth IRAs only and not that TSP is because TSP does have required minimum distributions even from the Roth side. They force you to do it from the traditional side, but they also force you to do it from the Roth side. And this is not something that most people will want. And so if you've worked hard to get your money into the Roth account and you want it to stay there as long as you can, you don't want to be pulling required minimum distributions out of a Roth account if you can help it. And you can help it because you don't have to leave your Roth money in the TSP. You can move it out and take advantage of the IRA rule of not having a required minimum distribution. You need to know and understand the TSP rules, or at least work with someone that knows and understands these rules. There are little things like this all around federal retirement planning. Messing these little nuanced rules up can be costly. A fourth reason to consider Roth is maybe that you're moving to a state with higher taxes in retirement. If that's so, then you may want to do some tax planning and get stuff shifted while you're still in the lower tax state. A fifth reason to consider Roth is that it's a great savings vehicle for college. And what I mean by that is when you put money into a Roth IRA, it can grow tax-free. And if you need to access the money from a Roth IRA and you're not 59 and a half, you still can access your contributions, or what's technically called basis, anytime, no taxes, no penalty. So let's just say you put $6,000 a year in for 10 straight years. That means you've contributed $60,000, and let's say the account's now worth $100,000. You can access the $60,000 anytime you want to. No taxes, no penalties. If you're 59 and a half and over, and you've had the Roth account for at least 5 years, you can access the full $100,000. No taxes, no penalties. And what's great about saving for college this way is that if you need some of the money, you can access it. And if you don't need it, you don't have to access it, and you can leave it there in the Roth growing tax-free. As you compare this to some of the 529 plans or other college savings, you'd better spend that money on college or there's going to be taxes or penalties. The Roth gives you some flexibility. And so if you think tax planning is important and you want to have someone that understands these principles and understands the benefits of walking through, how can you do this for yourself? Reach out to ChristyCapital.com. If you want to work with a professional, please reach out to the website. Give us a call, the number on your screen. I'd love to talk through the situations that you have. Who's making your investment decisions on potentially your largest asset, the TSP? If you're worried that you're not doing it right, if you're worried that some nuanced rule like the RMD on your Roth TSP is going to wreck your retirement planning, and you want to work with somebody, please give us a call. My name is Mel Stubbs. I'll talk to you on the next video. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly, can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally. So seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.